In this video, we look at adjusting journal entries. To effectively understand this concept, there are 3 steps to complete. First, defining adjusting journal entries and understanding why they are needed. Next, remembering the general rules associated. And finally, completing examples to fully understand the concept. So what are adjusting journal entries? According to the ACCT2 financial textbook, they are adjustments made to the journal for expenses not already recorded or revenue earned that remains unrecorded. This becomes clearer when we look at the 4 reasons for completing adjusting journal entries. The 4 reasons we look at are accrued revenue, accrued expenses, deferred revenue, and deferred expenses. These provide greater meaning to the definition looked at previously. Accrued revenue is revenue recorded before the cash is earned. Accrued expense is when expenses are recorded before the cash is earned. Deferred revenue is the term applied to receiving cash before the revenue is earned. And finally, deferred expense is when cash is paid before the expense is recorded. Out of everything, these tips and rules should be remembered so that mistakes can be easily avoided. First rule to remember is the cash account is never involved. An account from the balance sheet is affected. An income statement account is affected. Adjustments are made at the end of the year, and the debit and credit rules from the general journal entries. So in this stage, we look at our application of knowledge. So these are our examples, and first up we have office supplies of $200 were previously recorded and journalized as assets. The remaining value of the asset is $70. Record these changes. So this is our general journal entry. So first up, we are increasing our supplies expense account and decreasing our supplies account. So our supplies expense account is an income statement account, and our supplies account is a balance sheet. So if you remember, one of each should always be affected. Number 2, equipment is purchased at $3,000 and depreciates by $50 per year. This is our general journal entry. What we have done is we have increased our expense of depreciation by $50 and decreased our asset account of equipment by $40. Again, we have our 2 different account types. Third up, we have our company previously recorded payment before completing a service and recorded as a liability. This has been paid in full at $500. Record the general journal entries. This is what they look like. So our unearned revenue account is decreasing and our service revenue account is increasing by $500. Again, we have our balance and income statement accounts. So these are our adjusting journal entries, and as you can see, no cash account was involved. So that is what they are, and this is what we have covered in the video. Thank you for watching.